Hello and welcome back to Game of Trades, your number one channel for videos on the stock market and cryptocurrencies. All eyes are on the S&P as it attempts to recover off that October 2022 low and decides whether or not we need to price in a recession over the next few months with rising unemployment, decline in spending, contraction in earnings, or whether investors can begin to look at an economic recovery following the inflation shock that we had that brought down the markets. If we look at Google Trends and we take a look at what the interest is for the word recession, we can clearly see that's been declining very significantly since June of 2022. Now just quickly think about that. June 2022, that was right here. That is June of 2022. So recession fears were at their highest as the market was bottoming, or at least in the process of making a bottom. It undercut briefly that bottom in October of 2022. Since then, we've had the markets rally. We had a powerful rally in August, another powerful rally in the second half of 2022 and January of this year. And look at what recession fears have been doing here. They've been moving down decisively, and you can see we actually had a very similar type of situation back here in 2008, where recession fears between July of 2007 and January of 2008 were spiking here. Then we almost had a 6-month period here, half a year, where recession fears were going down, declining. People were not worried about a recession anymore. During that time, of course, the markets were rallying here. Then the weakening economic data started to come back into the picture during the actual recession, right? No recession in this first spike. The real recession in 2008 occurred during this period, and we all know what happened to the stock market right here. So this is something I want to talk about in this video. I'm going to show you quite a few different charts that hopefully are going to give you a better sense for whether people are right to be less concerned about a recession, and that we're heading back into an economic boom environment where recession fears are very low. Nobody's looking that up on Google, or whether this is really a bull trap exactly like what we had here in June of 2008, and we're about to see the economy go down in shambles again. If you enjoy this type of content, make sure to click on that subscribe button. We make these videos multiple times a week, taking a look at the markets, the economy, and what opportunities we can find. Don't forget that there are many ways to interpret the same data set very differently. There are lots of very smart people out there that have very different opinions to me. So stay open-minded, stay respectful, and make sure to smash the like button as hard as you can. Now, without further ado, let's get right into it. So the first chart that I would say is relevant is the fact that the unemployment rate is extremely low. Now, you probably haven't heard that as an argument before, but I think this is incredibly powerful because throughout history, you go back to the 1950s, when you have the unemployment rate go this low. If you go back to the 1950s, you can see systematically a low unemployment rate marks the end of an economic cycle. It marks the end of a boom cycle. So recently in January, we had the unemployment report come in at 3.4%, which is the lowest level we've had since 1960s. So the job market is indeed at the end of its cycle. And you can see every time that happens, in the near term, it doesn't bode well for stocks. 1974 here, 2000 right here, bottom in the unemployment rate. Very strong jobs market here, very strong economic data. Guess what happens to the stock market? Well, it's at the top. 2008, same thing, market tops as the unemployment rate is bottoming. There's a lot of people out there that share the narrative the job market is strong, and so the economy is strong, and so that means we can be optimistic about the future, and we're likely to see stocks rise. But the truth is, you look at this chart, the jobs market is systematically the strongest when the stock market is making a top. Now, of course, the drops that follow these tops in the market vary, right? In 1957, it was a very small drop that was very quickly followed by a strong bull run. In 1974, it was a massive drop. 1979, you actually didn't see any drop. So take everything with a grain of salt. Although arguably 1979, when you adjust the market for inflation, it wasn't such a great moment to be in stocks. Now, another chart that can hopefully give you a little bit of context behind the current market environment. This has nothing to do with the economy, but everything to do with the markets and how investors are currently positioned. This is essentially an indicator that essentially shows you the retail cash positions against the market cap of the SP500. So how much retail investors or individual individual investors are invested in cash versus stocks. And so you can see here as markets make big tops, retail money is typically very much invested in the markets. Same thing here in 2007, very much invested in the markets. However, when you go through recessions, and we have a few examples here, the 1982 recession, we have the 1990 recession, the 2000 recession, and the 2008 recession. Those were all the real recessions that we had in recent financial history, with the exception of COVID. But you can argue that this was very different to anything that we've seen before in history. Now look at where the retail money market ratio typically ends. After a recession, it goes up above 9 every single time. Now, of course, since 2009, we haven't really seen an actual recession. So if we are indeed heading into a recession, which we're going to talk about in just a second, but if we are indeed heading into a recession, and today looks anything like what we've seen throughout history and how individual investors can switch from being invested in the stock market to money markets and being invested into cash, this indicator is telling us we could perhaps have a lot farther to go before we actually see full capitulation in the market. Now, I want to be very clear on this indicator. This is not a timing tool. This is not in any case something that you can point to and say, okay, this ratio is low. That means that we should be going short on the market. That's absolutely not what this is saying, because the fact of the matter is that this ratio has been low since 2013. So that's 10 years where the retail money market ratio has been low, and investors have been very much right about being invested in stocks. What this is saying right now, the fact that this is still very low and it still has a lot of room to go up, is only doom and gloom if you do expect that the bear market is not over and you do expect that we are heading into a recession that has not yet been priced in. If history repeats itself, you see the most amount of capitulation in the market in the last phase of the bear market. You can clearly see here it was a soft, gradual rise until the very end of the bear market, where you had that big capitulation spike. Same thing here in 2001, big capitulation at the end. 1990, same thing, and again in 1982. Now, another chart I want to show you here that I do think is extremely relevant right now is leading economic indicators. This is the year-on-year percentage change in leading economic indicators. You can see what's been happening more recently. We've seen these leading indicators go down into contraction territory. So these indicators that are supposed to lead the economy are currently anticipating an economic contraction. And you can see these indicators are successful at predicting real GDP. You can see here real GDP crashing around a year and a half after these indicators start to dip into contraction. And same thing here in 2000. You typically see these leading economic indicators go down into contraction 6 months to a year before the recession actually starts. You can see that gray bar here, 2001, 2008. The actual recession started around a year after these leading economic indicators started to anticipate a contraction. So this is not telling me that the recession is behind us. This is telling me that it's in front of us, that we've actually yet to enter a recession. You can see that gray bar here. It begins in December of 2007, right here. That's almost the exact top of the stock market right here, December of 2007. You can see by the time that this was actually the case, leading up to the top in 2007, that the economy was going to contract, that we were heading into a recession. The same thing was true right here when the 2001 recession began. That was right at the beginning of 2001. The market was around here. It had already begun its decline, and leading economic indicators were telling you that you were about to enter an economic contraction. In addition to that, we are getting evidence that perhaps inflation is stickier than we thought. This is a chart of copper versus ISM services business prices, showing you how closely correlated these are, and how copper currently is pointing to the fact that inflationary pressures are not quite done yet. So not only is the economy weakening rapidly here, but we also have evidence that inflation could end up perhaps being stickier than what we were saying back in 2022, when, by the way, copper was crashing back here. So sticky inflation and underlying weakening fundamentals don't tell me right now that this decline in recession fears that we've seen more recently is actually justified. I think there's a non-negligible chance that we see people start to get worried about a recession again in the next few months as data starts to deteriorate, as the unemployment market starts to deteriorate. We're at the end of an economic boom cycle, not at the beginning of an economic boom cycle. And that is currently what we are betting on at Game of Trades. Now, we did say there could be a short-term bounce, and that seems to be happening right now. Price is bouncing beautifully off that 200-day moving average right here. That can potentially hit around 4,100 before eventually we do see that turn around and the market begin to price in a recession. Of course, we have our entire thought process, our allocation right now, looking into 2023 and all the short-term setups, the key levels, the targets that we have for the assets that we currently have on our tactical watch list. We've just installed a notification system for this, so if you're a member, you should be from now on receiving notifications as soon as we update the watch list and whenever we make changes to the model portfolio. Now, that's about all I wanted to cover in this episode. I hope you guys enjoyed. If you did, don't forget to smash the like button and click on that subscribe button if you haven't already. Now, in the meantime, I wish you good luck on your trading and see you next time.